Well, good morning or good afternoon, depending on what side of the country you're on. Charlie McQueen, President of McQueen Financial Advisors. I want to thank you for joining us for our webinar presentation today, Gaining Profitability Momentum, Leveraging Alternative Portfolios. And two wonderful people joining me today, Kelsey and Zach. I'm excited. Kelsey and Zach are two senior investment advisors with McQueen Financial, and also they're investment advisors in our alternative portfolio space. And so they have a lot of great knowledge about our topic today, leveraging alternative portfolios. Thank you both for joining me today.
Yeah, excited, Charlie. Thank you.
Yeah, thank you. And thanks for everyone for joining us too.
Yeah, great group joining us today. Zach, you can flip to the next page here. This is something to us that we're super excited about having you here. And I'm really excited that both Kelsey and Zach, along with me, have all worked in different areas of McQueen Financial, along with being portfolio managers. And one of our three verticals is our investment portfolio management. They also advise clients in asset liability management, our second vertical. And their third group, they don't as much time, the two of them, with, but our valuations team. Really excited about our valuation teams, our acquisitions that they do, and merger assistance and valuations of all sorts of different things. So lots of experience here in all three verticals that McQueen Financial represents. As we go forward to the next page, again, here's a bit of information on both Zach and Kelsey. They have great experience. They're two top-notch portfolio managers. Really excited to have them here. They both have great experience in portfolio management and asset liability management. Credit background, diverse backgrounds, but really great to have both of you here with us today. So thank you again very much. Today, just a little administrative stuff to kick stuff off. If you don't see it on your screen, you can move your mouse around. You'll see that there's a Q&A button. Please feel free to click the Q&A button anytime. I will be moderating questions, and we will be interrupting the speakers appropriately if necessary to ask questions, or we'll ask at the end. So please feel free to throw them up at any time, and I'll make sure we get them answered. Additionally, today's webinar is recorded and will be available on our YouTube channel. If you'd like a copy of it, please reach out to your advisor, and we can send you a copy of it also. So again, thank you very much for joining us. Next slide here, our overview of today. We've got a few things we're going to cover: an economic update, and we're going to talk about employee benefit pre-funding accounts, EBPA, charitable donation accounts, CDA, some really interesting success stories. I'm really excited. A lot of people have reached out to Kelsey and Zach and shared their success stories, and so I'm really excited to hear those. We're going to talk about returns. I'm really proud of the team. They've had some great historical returns on these portfolios and done a wonderful job. And then we're going to have plenty of time for question and answer. So again, please feel free to ask any questions along the way. So to start off, just a brief economic update. One of the things that is always interesting to me is history does have a habit of repeating itself, but we don't always realize it's repeating itself. One of the things here was really important. We look back at the last low interest rate environment after the financial crisis. We made it to about December of 2012, which is actually represented by the black dotted line here. Back in December 2012, the world started calling for higher interest rates. We stuck at that point with our original projection right when the financial crisis hit, that it was going to be a 10-year problem with 10 years of low interest rates, and this was about 5 years into it. We look at the yield curve today, it's almost exactly the same, even though long-term rates are even a little bit lower, but pretty darn close to the exact same yield curve. And we're hearing some of the same comments today that people expect higher interest rates. But we think we're about halfway through this curve here. We call a 5-year term of low interest rates, and we're about 2 years into it. So we're just about halfway in. The next slide here shows to me one of my favorite slides. Those of you who've heard me talk a number of times, I really love the slide group here, but it is basically the yield curve over a period of time. On the far left side, it's 2002. The far right side is today. And the red line's Fed funds rate, the blue line's the 2-year Treasury, and the black dotted line's the 10-year Treasury. If you look where we were again, going back to December of 2012, that was when the world was expecting higher interest rates. It took some time. And here we are today, a lot of people calling for higher interest rates. It's going to take some time. Are we going to see the 2-year Treasury and the 10-year Treasury possibly drift up a little bit? Absolutely. But overall, it's going to be a low interest rate environment. Lots of things going on. So that's the outcome. How do we get to this point? Well, this slide here is really an interesting one, unemployment. From a positive outcome, we're back to pre-pandemic levels of unemployment. The hard part here is the length of unemployment still is extremely high at 30 weeks. And so we're seeing not as many people coming back to the workforce as quickly as we'd hoped. That is causing some wage-based inflation and some also, I think, some frustration that we see in the markets and in the activities and fast food restaurants. And the next slide we're looking at here is one that's really interesting. Being that we're from Detroit, actually a couple of webinars always laugh about us being from Detroit talking about cars. What's really amazing here is I think this graph is wrong. It's showing that the time to turn inventory has gone from 100 days down to 37. I think it's less than 37. That's why I think it's wrong. We have a GM dealer I drive by, actually it's the Troy Motor Mall, about 15 different car dealers, types of car sales. If anyone has more than 6 cars on a car lot that usually holds 1,000 cars, I'd be surprised. So the inventory turn, I think, is about 4 minutes. But we're definitely seeing, and we actually began to see some write-ups recently that we're looking at a $200+ billion hit to the automotive industry of lack of production because of the chip shortage. And this is one of the things that we talk about, and we hear people talk about transitory inflation. A lot of it's based off of things like not having computer chips. So used car prices have really come up to all-time highs, which has caused inflationary concerns. At some point, those chips will show up again and prices are going to come back down as cars become more prevalent. There's scarcity here, supply and demand issue. The next slide, we can talk a little about supply and demand here. It's home sales also. We've seen home prices come up dramatically. People ask me every day, are we in a housing bubble? I don't believe we're in a housing bubble. And the reason being is it is people buying houses to live in. People are buying houses to live in. They're not buying houses to have 10. Now we're beginning to see some VBRO growth or rental growth where people are buying homes and renting them. That's still in the infancy stage, in my opinion. Why are these down? Why are the home sales down, new construction down? That's just supply and demand. There's just not enough homes going on the market because, I mean, one of those crazy things you don't want to do is sell a home today without buying one, even if you're downsizing. It's just difficult to find things. So we're definitely seeing a little bit of slowdown there. One of the things, though, that's good with the economy, this is a good indicator of how good economic activity is crude oil is at a reasonable price. It's actually been a little higher than I like. Some of that is some political shooting ourselves in the foot for stopping all pipelines and all drilling. Usually bad outcomes come from that. This is another component of inflation. Gas prices are up substantially, and heating prices, natural gas prices are also up substantially. And those are another big component of inflation. So with that, it's come up from a negative number to a big positive number. This is going to be something I think that's going to be interesting with the consumer here. On the next slide, it is the summation of everything I really want to talk about today. It's the question I get asked on a daily basis. Is inflation out of control? What is transitory inflation? So I do think we have 2 types of inflation. We have real inflation, which is wage-based inflation. When you have wage-based inflation, wages don't go back down. And what ends up happening is things cost more, especially in labor-intensive activities. You're going to see those costs go up. You see fast food costs going up very quickly, a lot of labor costs in fast food. But we also have some transitory inflation, such as the price of automobiles, the price of gas. We're also going to have the price of chips or the lack of chips. So at some point, the transportation problems get fixed, and we see that inflation come back down, but some is going to stay in place when it comes down to wage-based inflation. PCE up 4% this year. It was 1% last year. Add the 2 together, it's 5%. Divide by 2, your 2.5% rate of inflation for the past 2 years. Is it higher than the Fed wants? Yes. Is it going to go a little bit higher? Probably. It's not as bad as the headline number yet because we were so low for the previous couple of years. But inflation is something we're keeping a very close eye on. So with that, with the next slide, we do expect the Fed to keep rates remain unchanged for the foreseeable future. They're talking about tapering at some point here. Fed meeting yesterday, they talked about maybe late this year, next year, but they're talking about tapering. they do need to taper their asset purchases and stop asset purchases before they'd actually start raising the Fed funds rate. So we do see at least the talk is starting. It's going to still be at least a year out before we see the Fed start to play with the Fed funds rate, if not 2 years out. So with that, thank you guys for the time. And I'm going to hand the presentation off to Zach and Kelsey to talk about alternative portfolios.
All right. Thanks a lot, Charlie. Appreciate that setup. So diving in to alternative portfolios, I can definitely speak for myself and Kelsey and Charlie. This is probably one of our favorite topics that we get into at McQueen. Kelsey, top 10, where does it land with your favorite topics? We top 3?
I'm going to say it's just number 2, just behind tea time.
Tea time. There we go. I'll drink to that. That's awesome. So yeah, we love this thing. If you're on this call right now and you're listening to us talk, if you've ever spoken with myself or Kelsey, we probably brought this up a lot. Either you're already in these accounts and you're just kind of, maybe you invited some folks on to bring them up to speed. Or maybe we've been talking about how these portfolios might be able to help you. It's such a fun topic, especially because of what Charlie just mentioned. We're looking at low interest rates that are historically low. And not only that, they're going to stay here for quite some time, as Charlie mentioned. That's our prediction. History will likely, if not repeat, it will rhyme with what happened before. It's going to look the same. So this is a way for us to kind of navigate that situation. All right, so let's look at what are we talking about when we talk about alternative portfolios. So basically, they come in 2 varieties. The top one here you can see we call an employee benefit pre-funding account. Now, I'm guilty of using acronyms a lot, so you'll probably hear us just refer to EBPA. So just remember the E, that's employee benefit, and that's the top one here. The second one we're talking about is a charitable donation account. We call it a CDA. We'll get into a little bit about what these are, but I do want to say this at the beginning here. If this is your first time being introduced to this topic, I would recommend after this, go back and look at the presentation that we put together at the beginning of the year. Go to McQueen's YouTube channel and check it out. On that presentation, we went a little bit more into the regulation side, a little bit more there. Today's going to be a focus on profitability. And our real goal is to paint a picture. How can these go from just accounts that are out there that you might be able to use, and how can they become real things that can tangibly affect your community and your institution? So let's get into it. So at a high level, what we're talking about here, alternative portfolios provide additional earnings for you. That's the whole point. Now, what type of goal that they accomplish, it depends on which of those 2 programs that we're talking about. So bullet point 2 here, you can see offsetting benefit costs or gifting costs. That's really what we're talking about. But the third bullet point, I think, is the most important. When we think about how are we going to navigate this low interest rate environment, what can we do differently? One of the things that these portfolios, regardless of which one it is, what they let us do is we can invest in what is normally considered an impermissible investment. So we're not going to, do that boring stuff. We're not going to do the treasuries and that kind of thing. We're looking at things that are much higher earning potential. So some of them are listed here. You can look at corporate bonds, preferred stocks, ETFs, mutual funds, et cetera, et cetera. So these asset classes are much higher earning potential, and that's why the provide additional earnings bullet point makes sense, because of these asset classes. Okay, now that's what they are as a kind of a high level, but who is actually using these things? So when we look at the employee benefit plan, about 30% of credit unions are currently using some type of employee benefit plan. And I love that number. We think about if this number was 1% and you're on this call, you might be thinking, wow, do I want to be, the start of this? You're not there. And if it was at 75 or, 100%, well, then there's no competitive reason to get into this. Everybody's already done it. Maybe you should get in it because everybody's already doing it. But with 30%, we're looking at a real competitive advantage with enough of a track record that there's an established course ahead of you. You're not going to be the first one blazing this trail. A lot of credit unions are currently using this, and it's a way to really get ahead of the pack, the other 70%. Now, as far as asset size, you can see a massive range here. I mean, we got a $400,000 asset size all the way up to billions and billions. So it doesn't matter where you are on that scale. There's a precedent for this working for any asset size. Now, the charitable donation account is a little bit different because what we see here is only a 5% market adoption up to this point. I was surprised by this. Kelsey, when you saw the 5%, when we did the analytics behind the scenes, did that surprise you too, that only 5% were taking advantage of this?
It did surprise me, but also for even more context, I think when we first pulled this figure maybe a year and a half ago, the number was closer to 3%. So just the growth in the number of institutions that are starting the CDA portfolios in a year and a half from 3% to 5%, I would say is pretty exponential. So it is definitely gaining popularity.
Yeah, absolutely. Almost 100% increase in such a short time. We fully expect that 30% number is going to be 50% with a blink of an eye, and the charitable donation account is rapidly gaining traction as well. So a little bit on the guidance. I said we weren't going to go too far into this. We'll go a little bit into this. It's important, and before making any steps towards these accounts, you have to understand this. It's a crucial, part of the process. So here's some high level stuff. The EBPA, you are allowed from NCUA guidelines to invest up to 25% of your net worth into this account. For the CDA, you are able to invest 5% of your net worth. Now, the 25% for the EBPA is more of a guideline. It's not exactly, written on a tablet anywhere. The CDA is a little more black and white. We won't go into too much of those details, but these are things that you need to understand. But I thought what would be fun as a part of this, the context of profitability, if you're sitting there and you got a pen and paper or an Excel file open, throw down your net worth, calculate 25% and see what that number is. And as we begin to talk about some of these earnings, that I think will make this so much more valuable. You can see what the impact here might actually be for your institution. And you can start to dream a little bit about how is this going to offset my cost, increase profitability, et cetera. Okay, now reasonable risk. You have to understand the risk. We take into consideration all sorts of risks in the market, but you need to understand it. It needs to be clearly laid out. And so reasonable risk according to your credit union, and you need to understand it, policies and all the rest of it follow that. Okay, now the employee benefit account, to get a little specific here, as you might expect, this is designed to offset your employee benefit expenses. So that 25% of your net worth, picture that number, any earnings off of that directly have to be connected to an employee benefit expense. Now, what are we talking about though? What type of expenses? Anything? Well, not quite anything, but a lot of things. And here's a few examples. So we have health insurance premiums, life insurance costs, and retirement expenses. Those are the big ones. Now, we have a little cheat sheet that you can fill out if you want to know, well, what is my exact dollar amount? We have a cheat sheet for that we can help you with, but it's pretty straightforward for the most part. And one of the things to note here, all of these numbers are becoming much more expensive. Charlie, you mentioned inflation. Maybe it's not everywhere. Maybe it's not lasting. I tell you what, though, we're seeing a lot of inflation in these numbers, aren't we? Big numbers. So let's go on to the next one with the charitable donation account. this is my favorite. I try not to get too excited with this, but I love it. This is all about the giving back to the community. So when we talk about the charitable donation account, we're talking specifically about giving to nonprofit organizations. Now, I've been in a lot of different conversations with management, with board members, and when this topic comes up, it really, you get people kind of speaking up that you don't normally hear from sometimes. And they say, hey, that thing that we wanted to do a couple years ago, that charity, maybe we could use this to give to that. And it's really fun. You can think about your demographic. Who do you serve? Maybe where, when you first started as an institution, who was your core membership? How much of a part of your current membership are they? And that might drive specific charities you might want to focus on, and even get your membership involved with coming up with ideas. So as far as regulation, a typical CDA portfolio is required to give 51% of all the income. Now, some states require 100%. And we'll cross that bridge when we get there. But I tell you what, with our conversations with regulators, we've been able to really get on the same page and make sure that all institutions are taking advantage of these programs in the best way they can. And so one thing to consider, I mentioned before, is that you can only gift to 501c3 charities. That may seem like a limitation. We look at it as a benefit, especially if you're at the end where you're getting a lot of different knocks on the door. Hey, donate to me, donate to me. That's probably a big pressure. Which one do you say? Who do you say yes to? Who do you say no to? So by having this restriction, you can actually focus in on some of your giving, the gifting cleanup here. Okay, getting into a few hypotheticals. Now, let's say you wanted to donate $100,000 to charities. What we did here, very simple math, bear with the simplicity here, it's just to kind of paint a picture, but we have $10 million in assets. So let's say those $10 million in assets were earning 1%. That 1% earnings is represented by, you would earn $100,000. So 10 million times 1% is $100,000. Now, if you were able to earn a higher rate of return in a charitable donation account, let's assume, take the same $10 million and you invested it in a return of 4%. So now that $10 million times 4%, your earnings go up to $400,000. All right, so what does that mean? It means now you have a couple different options, which I think both have their merit. I think both of these are great. So the first option is you can simply increase your giving. So when we look at that, if you earn $400,000 total, you could just give it all away, 4 times increase to the original giving. Now, the second thing is you could increase your giving and simultaneously increase your earnings. So let's say you take that same $400,000 and you gave away 200 of it. Now that is a literal 2x increase over your original $100,000 giving. So you gave 200 away, it's 2 times more than you did last year. And now the remaining $200,000 you can boost to your earnings. So this is why the understanding the regulation is important, right? The giving away at 51%, retain the other 49%. And that's what the second option is showing. Either way, much better situation than the prior, where you're only giving away a small amount because the returns are so limited. Okay, the fun part now, we're going to get in some real world examples. And when we think about these success stories, we're gonna talk about some quotes and some situations. But I think the most value here is what are the lessons that we can learn from these real world examples. So let's look at our first one. And Kelsey, we have here EBPA. We have a quote from Patty. What does Patty tell us?
All right, so this is from Patty. Thank you, Patty, for sending this in to us. She said, I wish I would have done this when you first recommended the program to me. I'm making an additional $400,000 a year. So for some context, for those of you on the call, this portfolio is a $10 million EBPA portfolio that was opened a year ago. So after realizing a year's worth of earnings at about 4% return in this account, Patty is seeing that $400,000. So I think there's a couple of lessons here. The first one, the more obvious one, is just the nominal benefit. This is a great increase to income that this institution had. But the second one, maybe kind of implicitly involved here, is the time value of money. Because what this client in particular wishes was that they had set up this higher earning portfolio 2 years ago when the idea kind of first was brought up to them, because then she'd be looking at 2 years worth of these additional earnings instead of just the one. So, a dollar today is always more valuable than a dollar a year from now. And I think that's kind of the main lesson in this case, is that if you have the opportunity, if you're about to start your budgeting season, maybe consider one of these accounts to get started in the new year. It's a good time for it because you'd rather have been earning that additional higher income now versus waiting.
Absolutely. Our next webinar coming up, Charlie will get into the details at the end here, but it's we're going to be looking at budgeting, and budgeting. I'm having those conversations now next month, right? Next month. So it's such a perfect time. The setup process is simple, but it does take a few weeks with the policy development, the strategy development, making sure everybody's comfortable with regulation, the board, and all that. So it's such a good time to think about that and set up for 2022.
Absolutely. Who's our next quote from, Zach?
All right, we have Dave here. Last name's, what do they call it? Redacted? When you white them out? Yeah, redacted to protect the innocent here. So we have Dave. And Dave says, we reviewed our charitable giving for the last 5 years, and we realized we gave on average $100,000 a year to charities. So that $100,000, I'm sorry, each charity received approximately only $1,000 from the credit union. So we realized that our giving was not very impactful to our membership and our community. And this is basically the same thing we're talking about with the example, is that if you spread out your giving to a lot of different people, it's going to be a little bit of impact. I think about it, if everybody in the world got $1, nobody's lives would change at all, nobody. But if you give one person $1 million or whatever, it's going to, $1 billion is going to really impact them. So the middle section here says a client opened a CDA portfolio with McQueen. The returns that they're seeing are 4.5%, and that's a huge amount of giving. $450,000 is huge. So the finality of the quote here is we're able to give more targeted giving and are able to give 4 times more than before. So it's huge impact. And again, these numbers, you might look at that and 10 million might seem small, or they might seem really big. Take that 5% of your net worth and maybe start with this number right here, maybe a 4 or 4.5% return, and think about what type of earnings that might mean for you.
Yeah, and one more thing on that, Zach, that I don't think we've talked about yet on this call is this account may not be doing this, but it is possible to set up your own 501c3 charity under the umbrella of your credit union. So in that, kind of paired with opening a CDA portfolio, gives you even more discretion and even more strategy that you can use to impact your giving. And I think that's a really cool idea as well.
It's kind of a launching off point, right? You make money on the CDA, goes into the foundation, and from there you can kind of survey the land. Where do I want to give from here? Not necessary, but it's a really good potential tool for sure. And then going into our final quote.
Yeah, so our last quote, this comes from Lisa. She said, "We all know how difficult it is to retain qualified employees. To help us retain over 98% of our employees, we have been actively using the extra income earned from our EBPA portfolio managed by my partner, McQueen Financial." Well, I love this quote because, it cites us as a partner, and that's how we feel with all of our accounts. So that's really great. Thank you so much, Lisa. And the lesson here, again, it's maybe kind of on the obvious side, but employee retention is such maybe an issue for a lot of institutions right now. Charlie talked about the wage inflation that we're experiencing that is likely more permanent than the other transitory type inflationary measures that might be happening right now. And so an employee benefit portfolio is going to really give your institution a competitive advantage to retain your employees or attract new employees. For context on this quote, this is an account that opened several years ago, an EBPA portfolio of about 2 million, and they've been using this to see an active benefit ever since. And one other thing I wanted to note on this slide that's kind of related, this comes from our merger and valuations team. So they're pretty involved in the credit union merger space. And one thing that they've shared with us is that they have seen some success with credit unions that have already established an employee benefit pre-funding account. They've had it in place maybe for a year or two, and that's really helped that credit union to retain and attract the employees throughout the merger process and really helped that whole process go smoother. So if you are a credit union considering a merger, we really encourage you to think about getting an employee benefit portfolio started up. You do kind of want to have the established up and running for maybe a year so that you're not kind of dealing with this new account and everything that goes along with the merger. But if you are able to put that process in place, it could be really valuable to you in that merger process.
Absolutely. All right. So now everybody's wondering, right? What type of returns are we really talking about? We showed it a little bit, but you know, when thinking about the traditional portfolio for a second, if you invest in you're buying mortgage-backed securities and treasuries and maybe some bank notes and munis, we are excited to earn over 1% in this environment. It is just, wow, it's amazing. We got 120, right? 120 basis points. When we think about these accounts, we're really significantly more than that. But over the next couple of slides, what we're going to do is show a little bit of a breakdown. And one of the key takeaways here is that it's not a cookie cutter response. If you're thinking, oh, these sound great, do I check a box and then I get put into a thing? It's more than that. It's you wouldn't want to do that with your retirement. You don't want to do that with this. So there's various approaches, various asset allocations, and those various allocations that make sense to you from a risk perspective and a reward perspective, that's where the customization comes in. So we're going to take a look at a couple examples there. So going into the first one, Kelsey, what are we looking at here?
Yeah, so like Zach said, we're going to show a couple of examples. We've got 3 lined up for you, conservative, balanced, and aggressive. And these are just examples of some makeups of some current accounts that we have to show the variety and the potential effects to income. Because the returns on these accounts are definitely that's the biggest question. That's what everyone wants to know, understandably. So let's take a look at this first one. We're looking at a conservative portfolio asset mix. Let's first talk again about what the assets are in these accounts. Zach talked a little bit about it at the beginning of the presentation, the investments that are typically impermissible in your traditional investment portfolio. So what we're typically working with in these accounts are corporate bonds, preferred stocks, and common stocks. For the corporate bonds, if you're a federal credit union, these are not permissible in your traditional portfolio at all. So it would be a new asset class from that respect. Many of the state chartered credit unions are allowed to buy corporate bonds in their traditional portfolio, but what sets those apart from what we would focus on in these alternative portfolios are a couple of things. For one, we would be looking at longer term, instead of a 5-year max maturity, maybe a 15 or 30 max year maturity. We're also going to be looking at different credit tiers. Your regular portfolio is probably going to be focused on the highest rated corporate credits, AAA, AA, single A. In the alternative space, we're going to get into a little lower credit tiers, triple B, double B. within reason. We've talked about risk a little bit. This is all still about managing risk. We don't want to take any unnecessary risks when it comes to credit or any of these other securities. But that's the difference between the corporate bonds that you might see in these accounts. For preferred stocks, these are a hybrid security. So they have some features that a corporate bond has and some features that a common stock has. They have a fixed dividend, so they have a coupon payment that gets paid quarterly and doesn't change. But the maturity dates are typically very long or perpetual. You can see that perpetual preferred stock is its own category there.
I'll be your Vanna White here, Kelsey. Can you see the mouse?
Yeah.
Okay, there you go. A lot of words here. So here's what we're talking about.
Perpetual, yes. On the common stock side, these are equity securities. So what you probably typically think about when you think about the stock market, equity, like the Apple security, things like that. So in these accounts, this asset mix is what we're looking at. Where we can really get particular and very specific with each institution is how to allocate within these categories. So in the conservative example, bringing it back to this, let's take a look at the farthest column on the right under allocation. So in the conservative, we're looking at 30% towards corporate bonds, 60% towards preferred stocks between perpetual and non-perpetual, and then just 10% to common stocks. So only a 10% exposure to the equity market. Based on the market yields, about middle column on the page, these are current market yields based on where we see these things trading and available today. So based on the yields that we see and this allocation mix, we get a gross yield of about 4%. That's bottom middle of the page there. On this portfolio size, which is 15 million, that's annualized income of just over 600,000, with a overall benefit or increase to net income to the institution of about 15%. So you can see these higher yielding securities based on this asset mix. Already we're seeing a nice pickup over what our traditional portfolio is going to be offering us right now. So let's look at the balance. These next two will go a little bit quicker now that we understand what the assets are involved. But what's changing now is that allocation column off to the right. So on the balance side, we're going to put a little more exposure to the equity market. If we start from the bottom this time, we've got 40% allocated to common stocks, 30% to preferred stocks, and then 30% to corporate bonds. So it's a little more balanced across these three categories. Based on the yields, we have a gross yield in this type of account of about 5.5%. That's about middle bottom of the page there. On the $15 million portfolio, we've got annualized income of 825,000. The benefit or the impact to net income of the institution is an increase of about 20%. So with the change in the asset mix, based on the yields we see available, a little bit higher average yield on this type of portfolio.
Right on. And Kelsey, before we go on to the next one here, when we look at this 21% impact, increased income, and I'm just trying to put myself in the heads of some people sitting here on the call, they look at a $15 million portfolio, maybe they see that as a similar size for them or not. But regardless of portfolio size, would you say that 21% is a pretty indicative impact that we see across the board?
I would, yeah. Just because we're showing a 15 million portfolio size, that may be far smaller or far larger than your institution would expect to have, but these returns do scale. So the impact to income, the bottom percent on these pages, I think is pretty reflective of what most of these institutions are seeing.
Yeah, right on. And it makes me again go back to budget. Are we thinking that we're going to have a 10% decrease next year? Right? Maybe we go 20% higher and end up plus 10. A lot of ways to think about this as it relates to going into the next year. That would be great. Absolutely. All right, our final sample here.
The last one, we just went for the aggressive. So in this case, we kept it simple, 100% in the common stock category. So our portfolio has just 100% exposure to the equity market. That's got the approximate dividend yield and the return potential or price appreciation. That's really the benefit to the common stock portfolio. But based on these yields and levels, we are looking at 8.5% return. That's 1.275 million simulated on that $15 million portfolio size for an overall net benefit to income of 33% increase.
Yeah, I like the conservative 6% return here on the equity market.
Right.
If we've been paying attention to the market, it's done a little bit better than that.
Just a bit, yeah.
So I do like that. We're taking kind of the conservative approach here.
Right.
Okay, so well, before I move on, anything else on the samples, Kelsey?
Nope. I guess last thing is just that these, asset mixes, how we presented, are very customizable. They're not cookie cutter, like you said a few minutes ago. So, if you're an institution that's considering one of these accounts and you just aren't happy with any of these 3 asset mixes, that's completely okay, because each account can be customized to whatever you want.
Yeah, and also a pretty neat thing with these reports is they're not just for illustrative purposes. We can actually plug in any information here. So actual income can be put in here, and we can look at what the potential impact would be as a percent to recent income that you've experienced.
Yeah.
Okay, so before we get to the questions, let's take some key takeaways here. So the first bullet point is now is better than later. So what are we thinking about when we see this one, Kelsey?
Well, admittedly, now all I can think about are now and laters. But I know that's not the takeaway. What we do want the takeaway to be is that bolded now. This goes back to the time value of money. It's more beneficial to you and your institution to get these accounts started now versus later, and get the earnings going as soon as possible. That's the main takeaway there.
Absolutely. Again, it takes a little bit of time. It's not complicated, but it takes a little bit of time. So it's a perfect time right now to look at it. We got a couple months going into the end of the year to set up for an even more profitable 2022. I'll take the next bullet point. We have low rates are here to stay. This is, besides this topic, I think rates are probably my second favorite thing to talk about in the financial world. I love talking about it. But at the end of the day, there's not much impact we have on the rates themselves. All we can do is navigate around those around those low rates. So when we think about what have we done so far, most of you listening to this call have already lowered your expenses to the floor. We've seen non-maturity deposit rates drop, term deposit rates taking a little bit longer to roll off and reprice, but those are dropping. Borrowing costs have fallen. Very few people need to borrow, but those costs are low. So that side of the balance sheet, that side of the income statement, there's not much you're going to do there. You really got to look at the other side. And that's what we've seen a lot of successful institutions do over the last year. They've deployed out of cash, they've lowered expenses, and they've invested. So this is just really an extension of that. Instead of employing out of cash into traditional investments, we're deploying out of potentially much higher earning investments. So as we said, low rates are here to stay. This is not a temporary thing. It's time to increase that margin as much as we can. The third bullet point, Kelsey, you want to take that one?
Yeah, so third bullet point, stock market concerns can be avoided. So this goes back to the asset mix that you might choose. We showed 3 examples. All 3 did have an allocation to common stocks, but it's not a requirement for these accounts. So if you have a board that maybe just doesn't want the credit union assets in the stock market, you can still have an employee benefit or a charitable donation account, and it can just have allocations to preferred stock and corporate bonds, and exclude the common stock sector.
And additionally, too, oftentimes, if we think about the nature of our business, right, it's to manage risk not to eliminate it. So another way of managing the stock market risk is there are techniques that we employ, you can employ, right? So there are some of the management techniques, for example. I'm sure most people have heard of dollar cost averaging. So if you, the inverse of that is you get all in one place into a stock or a different investment. Where dollar cost averaging really helps is you get in over a period of time, and what that does is it smooths out the volatility of a market. So that's one way on the entry side. Another way is you think about the stock market. Most people think of the S&P. They think of the Dow. It's a straight up arrow, you know. But there's a lot of other stocks that aren't 100% correlated with the S&P. Right. You can look at low beta stocks. That's a stock that doesn't move quite as much when the stock market moves. Those are something you can look at. And also, it's possible to do protection within this. So we do what's, we have a strategy that we can actually implement some stop losses to where if a certain correction happened, we're actually protecting our earnings. It's such a powerful tool. It's not a set up, close your eyes and wake up one day and I hope everything was great. It's a very hands-on the steering wheel approach, and that makes all the difference with these things. All right, going on to the next bullet point. Anything else to add there, Kels?
Nope, you covered it.
Okay, very good. All right, next one is community impact. So this is the CDA, I guess, directly. The other one affects it too because it affects your earnings. The EBPA affects your earnings. But when I see community impact, I think of the charitable donation account, and picture your name on a billboard, picture you sponsoring the local high school. Maybe some names have fallen off, some dealerships, maybe they're not doing so hot. They've removed their support to your community. This is where you can come in, you can declare yourself as the person who's going to help out the community, and the benefit is obviously innate in that. There's innate benefit there, but also your name gets shown out. It's a free advertising for you. Your name's right up there, and people know who to go to when they need a loan or they need somebody to help them with their banking. And then you mentioned earlier competitive job market. Kelsey, do you want to touch on that again?
Yeah, so with the job market right now, we've got that wage inflation. The EBPA portfolio is one really good way to combat that, to offer other benefits, help you retain current employees, attract new employees, and really be competitive as an employer in the market right now.
Absolutely. 98% retention, as said earlier, is that's pretty wild in this market. And then finally, alternative portfolios are approved by the NCUA. It's an incredibly important thing to understand. Not only are they approved, they were literally designed to help you offset your cost. The NCUA knows expenses are getting more expensive. Is that redundant? They're getting more expensive. They know benefits are costing more. So it's time to offset those with these programs, and the regulations are here to support that. All right, Charlie, last bullet point. I guess that takes us to our favorite part.
All right.
Do we have any questions?
We do. We have a bunch of questions that came in, and I really appreciate you guys going through it. And you answered a few of them along the way, which is important. I knew they were coming up, so I didn't interrupt you. But a great technical question for you. One of our good friends put a note in here that says they already have some split dollar plans and 457 plans in there that they have already. Do those restrict us, or do they limit the amount of money we can put into an EBPA account? I love it. Everyone's thinking quickly. Yeah. So you guys want to answer? Or do you want me to answer this one? I'm happy to do it.
Yeah, go ahead, Charlie.
So they are going to look at all of the plans in aggregate. The numbers are not always perfectly equal. If you would have 30% of your equity already in split dollar plans and 457 plans, the answer may be you can't do it, and the answer may be you can. It's one where you have to look and talk with the regulators and look at the size limitations. They don't necessarily cancel it out. There are some different interpretations with individual regulators than regulation. That's something where we want to work through that. Part of this answer is going to be the overall risk of the institution and making sure that we're keeping into account the entire risk to make sure it's reasonable. Zach, Kelsey, anything you'd add to that answer?
Yeah, I would just go back real quick. Sorry, Kelsey, I see you're going to speak there, but real quick on this point is that 25% I mentioned earlier with the regulation, that is guidance. You're not going to see it anywhere except in a regulator's handbook, that if you have over 25% of your net worth in an EBPA or like funds or programs like Charlie's mentioning, they will look at it with a little bit more scrutiny. So it's a little less specific like the CDA is. That's cut and dry, 5%. But with this, we're really looking at the suitability, and as Charlie just mentioned, the risk. So yeah, it is a nuanced question that needs to be discussed.
Kelsey,
Yeah, you kind of took the words out of my mouth, Zach.
Oh,
I was
okay.
just gonna remind about the word guidance on that
Mhm.
25%, and that, regulators really want to make sure that regardless of the portfolio size, you have an understanding of the risks and you can explain why you've made certain decisions. So that's a really important part.
The next question kind of ties directly into that. How have regulators responded to CDA accounts and EBPA accounts working with a new institution? And I think effectively a little bit of add-on to that last question, but how have regulators responded when they come across our clients with new portfolios?
Yeah, I love this one. No, you go first, Kelsey, so I don't steal your thunder. I see you ready. Go ahead.
No, that's okay. I was going to say for newly opened accounts, there tends to be additional scrutiny just to make sure that they have the policies in place, they have a strategic statement, board minutes have accounted for everything getting approved. So the initial, I think, exam with the new account needs to make sure all these things are covered. And then on a go-forward basis, it's been a much simpler, less scrutinized process.
Yeah, I think that's well said. And to get ahead of this is we have a step-by-step process. It's actually fairly straightforward, literally numbered steps. And one of the things at the very top of the process is reaching out to your regulator. It's way better to let them know what you're doing so that they can ask you questions along the way, and that you can answer those questions and prepare those questions, which obviously we would help you do. We have a lot of experience speaking with regulators, and I've spoken to regulators directly. Craig, not on this presenting here, has worked very closely with Michigan regulators, and recently they came out and said, hey, we actually really support McQueen's how McQueen is interpreting the regulation. So we have Michigan full support. I've talked to federal regulators, and they actually, strongly encourage these programs as a way to, as we said, offset costs. So getting ahead of it is an important thing.
Mm-hmm.
That's a very, very good point. Very good point. And I know there's been a lot of effort we've spent, and the team you two have spent in making sure that everything is properly followed and documented. And that's one of the keys here is doing the process, following a process versus jumping into it. With that, this next question that came in talks about returns. But before I get there, I want to just first say how proud I am of the two of you and your entire investment team. It's a whole team effort to make this work. Just had some wonderful returns. You can never guarantee future returns, but we can share our past returns, which you guys have, and really proud of all the effort that's gone into that, and really happy for the additional dollars that our clients are able to utilize in this environment. With that, the question relates to portfolios and the type of portfolios. And this question says effectively, when you structure portfolios for EBPA accounts and CDA accounts, are you structuring them for cash earnings or for valuation growth, and why?
I love that question. That's great.
Yeah, do you want to take that one first, Zach?
Yeah, I'll take a stab at it, and I'm sure we'll have different angles here. But one of the things to understand, especially with the employee benefit account, and this ties into everything we've said so far, and the regulators are really looking at this account to be able to drive a somewhat predictable earnings to offset those very specific costs. That's super important. Now, if we just bought Tesla, zero dividend company, I think. They don't start a dividend yet, I don't think. Or we buy Bitcoin, right? We're not going to do those things, by the way. But if we did, there's no dividend, there's no income. So instead, what we do is we look to strong income dividend producing companies that we can then have a reasonable prediction of how much money that these accounts can actually earn. We can then offset those with the expenses that we expect. So is capital appreciation an awesome thing that we expect to have, especially with the equity side, the mutual funds, the ETFs, that kind of thing? Absolutely. But even as we have those growth potential, the focus is still going to be on predictable earnings with companies with a long history and a track record of paying a strong dividend and an ability, a fundamental ability to continue doing that in the future. Anything to add to that, Kelsey or Charlie?
The only thing I would add is I support that answer, definitely. I also like having any common stock exposure to have some type of dividend income for the cash flow as well coming into the account, because then we can keep reinvesting, at all different points of the market and really keep the portfolio growing in a good organic way.
I think that's some great answers, guys. I appreciate it. It really explains it well. And at the same point, portfolios can be designed for unique needs. If someone is looking just for a value increase, that can be done. If someone's looking just for cash flow, that can be done too. And part of it is the process that the team goes through to determine what your needs are and ensure that we're investing appropriately to reach those needs. And that's part of the process we flow through. So with that, I'm going to wrap stuff up here as we're coming into the end of the hour, as I know everyone's fairly scheduled in this day and age with calls on an hourly basis or half-hour basis. First of all, I want to thank Kelsey and Zach. I really appreciate the time, the energy, and your expertise. Thank you for the wonderful presentation today.
Thank you, Charlie.
Thank you. Our pleasure.
With that, if anyone has any additional questions, please feel free to reach out to your MFA advisor or reach out to Kelsey or Zach, and they'll happily answer any additional questions you have. Also, as a reminder, this has been recorded and will be on our YouTube channel. Feel free to go to our YouTube channel or reach out to the organization or your advisor and we'll get it off to you. Just remind everyone, coming up, we have, as mentioned earlier, our industry update for planning and budgeting is coming up in just a few short days, actually on October 5th. We had a lot of requests to have it early in the month in October, so October 5th is going to be the day. Please let us know if you've not received an invitation or like an invitation. Love to have you join us. We're going to be talking about all the things happening in the industry, what our predictions are for interest rates, mortgage volumes, loan type volumes, deposit structure, rates, all sorts of things. And hopefully by then we'll have a little bit of potential guidance of some of the changes happening in Washington, which will give us a little better insight to what to see this next year. Then coming up after that, on November 10th, we do have our investment update for our standard investment portfolios. We're going to have the investment advisor team give us an update on what's happening in that world. So with that, I want to thank everyone. Thank you for your continued relationship. Thank you for joining us for this last hour. And everyone have a wonderful rest of their day.
Thank you, everyone.
Thank you.
Bye-bye.